Up to 85% of your Social Security benefits can be taxed at your highest nominal rate. Many people believe that Social Security taxation is a form of double taxation because they already paid into the system via the payroll tax, and now they're having to pay on taxes on benefits coming back out. However, if you pay less taxes, you'll be able to spend more money, enjoy things more, and in general, your plan will be better. So today I'm going to give you 3 things you can do to reduce or eliminate taxes on your Social Security benefits. Hey everyone, I'm Nick Davis, founder of Brindle and Bay Wealth Management, and I'm here to show you how to retire with calmness and clarity. Now you may be surprised to hear that Social Security at one time was not taxed. Those benefits coming back out prior to 1984, almost 50 years were not taxed. And in an effort, bipartisan agreement, meaning everybody agreed that they needed to tax Social Security, they decided in 1984 to include up to 50% of your Social Security benefits to be taxed. And then again, in 1993, everybody agreed again that they needed to increase the taxes up to 85% of your benefit to be included. And don't get me wrong, I believe we should pay our fair share of taxes. I mean, after all, paying taxes, what I tell my children all the time, it's what gives us nice roads to drive on, and it keeps rabid dogs from running around everywhere. However, we have to be wise, we have to know the rules, we have to do what we can to put the ball in our court, so to speak, so that we can have the best plan possible. You see, certain types of income trigger Social Security dollars to be taxed. And it would be helpful if you knew what those sources of income were so that you could maybe prepare before you retire and maybe try to reduce those sources. So if you are pre-retirement, you're 3, 7, or 10 years away or more from stopping working, I'm going to give you 2 things you can do before you stop working to help reduce taxes, and then 1 thing you can do after you're done working and retired to help reduce taxes as well. So the very first thing you can do to help reduce taxes on your Social Security is to adjust the amount of dollars you're putting into your 401k. Because dollars that come out of your 401k, or your traditional IRA, or your 403b, or your 457, those dollars create Social Security taxation, whereas other types of accounts don't. And when I say that they cause Social Security to be taxed, what I mean is that they draw Social Security dollars into what's called the combined income formula. And I talk about that in the Social Security taxation video. So how Social Security is taxed, I'll link to that at the end of this video. But it causes it to be included into the formula, and it causes an additional layer of taxes to be considered for taxation. The other reason that it's a good idea to adjust the amount of dollars you're putting into your 401k and those types of accounts is that those types of accounts also have required minimum distributions. We talk about them as RMDs, which basically means that when you turn 72, you're going to have to start pulling those dollars out whether you like it or not. And you might not think that's a big deal. However, if you look far enough into the future, many people are overstuffing their 401ks and are causing a future tax problem. Let me show you what that looks like. I'm going to use a hypothetical Tracy and Tommy, who are in their mid-50s, and they were proud of themselves for maxing out their 401k every single year. But then they started to question whether or not they should be putting some money into Roth accounts in different places so that maybe they were being a little bit more diversified in the way that they were saving. So let's take a look. So looking way into the future, when they're both age 72, meaning now both of them who have 401ks and traditional IRAs have required minimum distributions, if we look to the far right side of that sheet, we see that there's an excess $35,000, meaning that's money that Tommy and Tracy did not want to take out, but the required minimum distributions forced them to because it was above what they desired to spend. So they had to pay taxes on it and decide what they were going to do with it. And then if you look at the years below that, it just happens again and again and even gets worse and worse over time because the required minimum distribution increases. So if they continue on the path of maxing out their 401k, they might actually be overstuffing their accounts. And so not only does this cause issues for required minimum distribution, but again, this is income that triggers taxation on Social Security benefits. So boiling this all down to a really practical step that you can take, and that is to find the balance for how much money you should be storing up in your qualified accounts and your non-qualified accounts and your tax-exempt accounts. The second thing you can do to work to reduce taxes on Social Security or even eliminate them is to put some dollars in Roth. And when I say Roth, I mean Roth IRAs or Roth 401ks. You see, the Roth election came about in 1994, whereas the 401k election came around in 1978. And Roth 401ks are even more unheard of up until the last couple of years. So the last couple of years, Roth 401ks are almost everywhere, whereas 5 or 7 years ago, almost nobody had any. They could only put money into a Roth IRA at that time. So any dollars that come back out of a Roth IRA or 401k are not going to trigger extra Social Security to be taxed. And that's probably one of the most underappreciated benefits of the many benefits of having a Roth 401k or a Roth IRA. How many dollars should you put in a Roth? Well, that's a very individual question. It's difficult to say because if you're high income now, you would be losing the benefits of reducing your tax bill now for the future. So everybody needs to work to find that balance for how many dollars they should put into a Roth. But needless to say, Roth does not trigger Social Security to be taxed, and that's a pretty cool benefit. In fact, your advisor should be asking for your taxes every year so that you can preempt this problem by figuring out the prioritization of how much you should be putting into your 401k versus Roth. So the third thing you can do to reduce or eliminate taxes on Social Security is to strategize your taxes every year. This is the single most important tax event of your year. It's the moment that you take your taxes and you strategize for one of a couple of different reasons. On the front end, if you're not yet retired, you're strategizing how much money to put into those different tax buckets, like in point number 1. So you're adjusting the dollars going into your 401k and qualified accounts so that you don't have a future tax issue. But it applies to you even more when you're not working anymore and you are retired and taking Social Security. After you're retired, something happens to you that's never happened to you ever before, and that's called phantom taxes. So if you doubt phantom taxes, just think of the Medicare means testing and the IRMA tax. You've never faced that. And really what that is if you have too much income coming in from 401ks and IRAs and pensions, you pay more for your Medicare premium, and then that reduces your Social Security benefit. We also have this extra layer of taxes that Social Security causes that's not necessarily intuitive. So phantom taxes are not intuitive. They're not good. I talk about it in another video called Social Security Phantom Taxes. And I'll kind of tell you what to expect in that video because it's pretty amazing. We have a family with $120,000 in income. They're in the 12% tax bracket, and they want to pull an extra $5,000 out to go on vacation, thinking they're going to pay 12% taxes or maybe even 22% taxes, but instead they pay 50% taxes on a $5,000 distribution to take a vacation. So that $2,500 tax bill surprised them, and I show you exactly how it happens in that Social Security Phantom Tax video. But the reason you want to strategize your taxes to reduce taxes for Social Security before you retired and after you retired, because it can look like this. I'm going to show you a picture of what it looks like for our clients at Brindle and Bay. You should be given a choice as to how you're going to distribute that money and identify those phantom taxes, because if you can avoid extra layers of taxes, well, that's money saved. And so in this example, you just see choice 1, 2, and 3. Again, your advisor collects your taxes before you take your distributions for the year. It'd be nice for you to see how the money's going to come out so that you can maybe massage it a little bit to benefit from a tax standpoint. Again, it's really important to figure out how you're going to take your money back out in retirement. So you prepare for it before you retire by how many dollars you put into each of the tax buckets, and you prepare for it after you retire by strategizing your taxes before you go to spend those dollars each and every year. So check out that video if that'll be helpful for you. Again, in summary, the 3 things you can do in full or in part, you'll benefit. Number 1, adjust the dollars going into your 401k. Number 2, put some dollars into your Roth. And the third thing is strategize your taxes each and every year. Don't just do your taxes, look forward and be strategic. Hey everybody, Nick Davis here. Thanks for watching. If you enjoy this, please consider subscribing. Also, if you would like to see the way that we help people master their retirement money so that they can go on to that next phase with calmness and joy, take a look at us at brindleandbay.com.